It is absolutely critical to know the key differences between business taxes and personal taxes. If you don't, you could put your business into jeopardy without even realizing it. So in today's video, I'm going to explain everything that you need to know about the differences between business taxes and personal taxes so that you can make sure that the tax headaches don't cause a major interruption in your business or your personal life. Without further ado, let's dive in. Now, the first thing that we need to go over is what are actually business taxes and personal taxes. As you might have guessed, business taxes are taxes that are owed by the business to the government. Personal taxes are taxes that are owed by individuals to the government. And yes, at first glance, that might seem extremely straightforward, but there are many different types of taxes that both businesses and individuals could potentially owe to the government, and you need to understand these. So, what type of taxes do businesses owe to the government? Let's start off with the business owners. Businesses can be subject to income taxes, which are taxes on the income that your business generates. There are also payroll taxes, which are taxes that business owners must pay to account for contributions to Medicare and Social Security on behalf of their employees. Business owners are responsible for paying half of their employees' contributions to Medicare and Social Security, and the employees pay the other half. There's also sales taxes, which are taxes that many businesses have to collect from customers and pay to the government for the privilege of making sales in America. There are property taxes, which are taxes that property owners have to pay on behalf of their business. For example, if you own a restaurant, then you would own property taxes on the actual building to the government. Property taxes are almost like rent that the government charges you in order to use a piece of land or building structure in America. Funny how that works. There's also excise taxes, which are indirect taxes on certain goods like fuel, alcohol, and tobacco products. There's also franchise taxes, which some states require business owners operating franchises to pay to the state. Examples of states that have franchise taxes in 2024 include California, Georgia, North Carolina, and Delaware. But there are many others. So if you want to open a franchise business, a corporation, then you should check to see if your state has franchise taxes. Don't get caught by surprise by all of a sudden finding out later when you file your tax returns that you're going to have to pay franchise taxes. Now, let's take a look at some taxes that individuals can be subject to. Just like businesses, individuals can be subject to a wide array of taxes. For example, individuals also have to pay income taxes just like business owners do. They can pay income taxes on many different types, such as wages, salaries, and other personal income. We have a progressive tax system in the United States, which means that as your income rises, so does your taxes. Individuals also have to pay Social Security and Medicare taxes, and if they're self-employed, they have to pay the dreaded 15.3% self-employment tax, which accounts for their full Social Security and Medicare contributions. If they're employees, they can split this cost with their employer, as I mentioned earlier, but if you're self-employed, you are your employer and your employee. Individuals also have to pay capital gains taxes if they sell capital assets, such as stocks or bonds, for prices higher than the ones that they bought them for. So for example, if you bought $100,000 worth of Bitcoin and you sell it in 6 months for $150,000, you have a $50,000 gain that you experience. There's also estate taxes, which are taxes on estates that individuals pass on to their heirs after they die. Keep in mind, however, that not everyone owes these estate taxes. You have to be quite valuable in order to owe estate taxes. For example, in 2024, if your estate is valued at over $13.61 million, then you would owe estate taxes. Just like businesses, individuals also owe property taxes on property that they own, including houses, condos, land, and individuals also have to pay sales taxes that are collected by businesses and given to the government. So both individuals and businesses have to pay different kinds of taxes. The exact taxes you have to pay depend on a wide variety of factors, including your income, whether or not you own a business, and more. Now, obviously, if you're an employee, you're not going to have to worry about paying business taxes. This is because your employer will pay the business taxes. You will just have to worry about paying your individual income taxes. But if you're a business owner, then it can be a little bit more complicated. The type of business entity that you own can have a massive impact on your overall tax burden. One of the most common types of entities is the pass-through entity. And you might be asking, explain what that means. A pass-through entity is an entity in which the income from the business passes through the business directly to its owners, who then report that income on their individual income tax returns. The reason why this is so important is because it means that business owners who own businesses that qualify for pass-through entities do not have to pay business income taxes. Instead, they pay personal income taxes. This is crucial because if you're thinking about becoming a business owner, you're going to think about having a pass-through entity and whether or not your business pay taxes, and you'll find out that you don't, you pay personal taxes. Sole proprietorships, partnerships, limited liability companies, aka LLCs and S Corps, give you pass-through taxation. Let's say that you own a furniture restoration business and it's registered as an LLC. Let's also say that it's a single member LLC and it generated $200,000 in revenue in 2024. In this case, your business entity would not owe any income taxes on the $200K of revenue. Instead, this revenue would pass through the business and it will be reported on your individual tax returns. Then you, as an individual, would owe taxes on the revenue minus your deductions you took. This is how pass-through entities work. And keep in mind that not all businesses are pass-through entities. C Corps, for example, are not pass-through entities. So you have to keep that in mind. Now, we have discussed the different kinds of taxes that both businesses and individuals can be subject to. Let's talk about the differences between state versus federal taxes. The federal tax rules apply to all businesses and individuals anywhere in the country. That is because these rules are nationwide. So if you are required to pay federal taxes, it doesn't matter what state you live in or operate your business in, you will still have to pay them. This is because they are imposed by the federal government, which has jurisdiction everywhere in America, and no one governs the IRS. However, state taxes are different. State taxes only apply to individuals and businesses with a connection to a specific state, such as living in a state, working in a state, having a business registered in the state. The rules can vary significantly from one state to another. For example, a number of states don't even have personal income taxes. If you live in an income tax-free state, such as Texas, Nevada, Florida, or other several states, you won't have to pay state government any income taxes when you file your tax returns. However, many other states do have income taxes, and a lot of these states have income tax rates that are extremely high. For example, California, Hawaii, New York, and New Jersey all have top state income tax rates that are above 10%. So if you're a high earner living in these states, you're getting crushed by income taxes in these states. So the state that you live in or operate your business in can have a massive consequence for the type of taxes that you're subject to every single year. And in fact, many people choose to either live or open businesses in certain states due to the tax laws within the state. So, how do you reduce your tax burden? It's one thing to understand the differences between business and personal income taxes. It's another entirely different conversation to understand how to reduce your tax burden. If you want to reduce your tax burden, then you need to know what the tax code has entail for the type of income you're earning. The U.S. tax code includes massive tax breaks for certain activities based on your income, and one of the most important of these is real estate investing. Real estate investors are eligible for some of the largest tax breaks in the entire United States tax code. And in fact, savvy real estate investors can leverage powerful tax deductions to reduce their tax bill by as much as 50 or even 100%. And this is true whether you invest in real estate full-time or if you do it part-time. If you would like to learn more about how to reduce your total tax burden in real estate, please click on the link below to join my free webinar. I'll explain it during the entire webinar. Now, let me answer a question from one of my subscribers. As promised, I always like to do this at the end of my video. This question comes in from Holster9620 on how to save money on taxes with an LLC video. The question is, hi Karlton, is it ideal to register your newly formed business as an S Corp even though you might not be profitable for the year or later after you become profitable? Okay, great question. I normally recommend for people to start out as a limited liability company, an LLC, because it's cheaper to file your tax returns as an LLC, and there's less requirement from you as a business owner for reporting things, such as your annual meeting minutes. When you switch over to a corporation, you will have additional documentation that you will need to do on a yearly basis. Plus, you'll need to file tax returns as a corporation, and you will need to file your payroll taxes. Those two items right there, filing filing as an S corporation plus paying payroll taxes could cost you about another $2,500. And so for many taxpayers starting out, it makes more sense to be an LLC. And then right when you hit about 50,000, we start looking at how much you pay in self-employment tax, that 15.3%, plus how much that payroll processing fee is plus your tax return, and we determine if the benefits outweigh the cost to make the S election. So if you're an LLC owner and you're wondering whether or not you should switch to an S Corp, refer to my video on when to switch from an LLC to an S Corporation, and make sure that you tune into my channel. I'll be putting out more content and videos to help guide you. Without further ado, I'll see you on the next video. Cheers.